At the outset, I am thankful to Taxmann for giving this excellent opportunity to revisit the subject and share my thoughts and understanding with all of you. I'm sure that in the process of sharing of knowledge and understanding of the subject, I'm also going to enrich my understanding. I will switch off the mic for better visibility, and we will start with the subject proper. Just a minute. Yeah. Just give me the moment. Presentation mode. Presentation mode. Yeah. So friends, shipping and airline, if somebody looks at the provisions contained both under the provision of the Income Tax Act as well as under the DTAA, the provisions are very short. If you look at domestic tax law, the provisions are contained under sections 172, section 44B and section 44BBA. As far as double tax avoidance agreements are concerned, the provisions are largely contained under Article 8 of Model Tax Conventions. In some cases, we may have to visit other articles of the treaty, especially business profit article. And as we go along, I will also throw light on that part. I have prepared a very detailed presentation, but for the sake of brevity, I might skip some of the slides. And instead of that, if there are questions from the participants, I would like to rather concentrate on the questions that the participants may cover. They may pose the questions. In my presentation, I'm going to deal with the provision of the domestic tax law as well as the double tax avoidance agreements, as well as I will also refer to a few case studies. And at the end, I've given some reference material giving gist of various circulars, the procedure for port clearance, and text of various domestic law provisions, and some of the case laws which you would like to understand. With this brief, let's proceed with the presentation proper. Now, a foreign shipping company or airlines could have various types of presence in India. Either they can set up a liaison office in India, or they can have their own branch offices, or they can have a joint venture in India, or they can set up a wholly owned subsidiary. They can also have an agency set up where agent may be dependent or an independent agent. And the agent should solicit customers, assist in cargo handling, deal with customs and port authorities on behalf of the principal. And they will earn commission from foreign shipping and airlines companies for the services they render. And they may or may not constitute P of the foreign shipping companies or airlines in India. Now, whether this P concept is relevant at all or not, that also we'll discuss as we go along. And there is a circular number 723 dated 19th September 1995, which says that the agents will step into the shoes of the principal. Now, otherwise, also, if you look at the contract act, the contract act says that whatever once in an agency relationship, when agent does something and when he is appointed as an agent, he will definitely step into the shoes of the principal. And whatever actions the agent takes, it will be binding on the principal. There are various types of operators in the shipping business. There's a mainline operator which own or charter vessels which carry cargo from the port of origin to the destination port. They issue bill of lading to shippers, NVOCCs for the entire voyage, and earn freight income from the shippers. What is NVOCC? We'll see in the next slide. The feeder vessel operators, they serve mainline operators whose vessel do not call port of origin or the destination. They own or charter vessels which may carry cargo between the origin or the destination port and the hub ports, that is also known as relay cargo. They issue BL to MLO for voyages between the origin and destination ports and hub ports, and they earn freight from mainly from the MLO. And largely, they are also known as the operators in the shipping business. Then NVOCC, which is full form is non-vessel owner common carriers. They do not own, charter, or operate any carrying ship, but they undertake transport of goods using container slots booked on the vessels of the other operators. So what they do is that wherever on various routes there are main lines operating on those areas, they book certain slots, space in that ship, and they generally own the containers and they issue BL in their own names. And to an outsider, they look as if they are the shipping line, but they really do not own or charter any ships. So they are known as NVOCCs. There's a tramp ship, which is a ship without a schedule, which is used mainly for carrying bulk commodities or homogeneous cargo in ship loads. And each voyage is separately negotiated between the ship owner and the shipper, usually through the brokers. There are various types of charters in the shipping business. There's a bareboat charter where base ship is given on hire, that is without crew or equipment. There's a bareboat charter cum demise where ownership is intended to be transferred to the charter after a specified period. That is actually a transaction for sale as per AS19. There's a time charter where it is a hire of a fully equipped ship, usually along with crew, and agreement is for a certain period. And there is a voyage charter, where there is a hire of a fully equipped ship, usually along with crew, and agreement is for a particular voyage. As far as the airline business is concerned, there are scheduled air transport services and non-scheduled air transport services. So in scheduled air transport services, those are the flights operating to a published timetable. Each flight is open to for the members of the public at large, whereas in case of non-scheduled, they are like a chartered flight, and they operate where operations where departure time, departure destination, and arrival location, etc., are negotiated and agreed with the customer, and no ticket is usually sold to individual passengers. Yeah, Pramod, you raise hand. So. Yeah, and what are the if there are dry lease also? In case where only aircraft is leased or chartered without insurance, crew, ground staff, supporting equipment, maintenance, etc. In case of wet lease, aircraft with operating crew and the full responsibility of the lessor for the operations and maintenance of the aircraft is there. With these, friends, we come to the provisions of the domestic law, that is Income Tax Act, which govern the taxability of a foreign shipping company and airlines. Now, income from shipping operations are covered by two sets of sections. That is Section 172, which is a summary assessment of a ship belonging to or chartered by a non-resident. As against it, there is a provisions contained under Section 44B, which is talking about taxation of shipping business of a non-resident. So what is the distinction between Section 172 and 44B? Section 172 deals with as the title suggests, summary assessment of a ship. So there is no SSC per se. So there is either an assessment of a ship, of a particular, say, visit of a ship, and or there could be just one ship of that foreign entity which has visited India, and you want to determine the taxability of the income of that particular voyage. So those aspects are covered under the provision of Section 172. However, when there is a regular shipping company which is operating in India, or even that particular ship which has come once to India and they would like to be governed by as an SSC and file regular tax return of tax, then they have option to be governed by the provision of Section 44B. And in that case, it will be an assessment of a person, the foreign shipping line itself. So under 172, it's an assessment of a ship or a voyage. Under Section 44B, it is the assessment of an SSC. If you come to the airline business, there's only one section dealing under the Income Tax Act, that is a Section 44BBA, and which talks about taxation of a foreign airline, and therefore there are no such provisions identical to 172 in respect of an airline. So there has to be an SSC as far as the airline is concerned, whereas in case of a ship, there is an option that you only go for assessment of a ship. So this what is to be kept in mind is that the provision of Section 172 as well as 44B deal with the profits from the operations of ships or aircrafts by non-residents from carriage of passengers, livestock, mail, or goods. So this is to be kept in mind. So one aspect is important is what is operations of ships, and second aspect is income should be from the carriage of passengers, livestock, mail, or goods. So these are the important aspects that which we'll keep on visiting during our presentation. These provisions are presumptive tax provisions in the sense that income is to be computed on a presumptive basis as a percentage of gross receipts. In case of shipping, it is 7.5% of the gross collections. And as far as airline business is concerned, it is 5% that is deemed to be an income. That means you will not get deduction for any other expenses, and the income will be computed as a percentage of your gross receipts. However, the SSC will have an option to be governed by other provisions of the Act before expiry of the relevant assessment year, and therefore SSC can decide that I don't want to go under the presumptive tax provisions. In that event, he will have to comply with all other provisions of the Income Tax Act. For example, he has to maintain regular books of accounts, get the accounts audited, and based on that, he can file his return of income in India. We'll go in detail about these sections in our subsequent slides. So if you look at Section 172, it starts with a non-obstinate clause. So it overrides all other provisions of the Act, and therefore Section 172 is a code by itself. So what is the logic? The logic is that you are only doing an assessment of a ship, and that ship has just visited, it may be just single trip or maybe very few trips that ship has made to India, and therefore the owner of the ship does not want to file a regular tax return, and he wants to complete the assessment for whatever income that he has earned and which is liable to be taxed in India. And therefore, there is no point in applying all other provisions of the Act, including provisions relating to tax deduction at source. And therefore, there is one circular number 723, which is applicable only in case of Section 172. So that is to be kept in mind, that the benefit of circular number 723 is available only in case of a assessment of a ship, where you are exempted from various other provisions, and that non-resident is not liable to comply with other PDS provisions. And even the people dealing with the shipping company also, the agent also will get out of the relevant TDS provisions. It is applicability is in respect of levy and recovery of tax in case of a ship which is belonging to or chartered by a non-resident. So ship belonging to, that means it should be either owned by a non-resident or the ship should have been chartered by a non-resident. And therefore, if you look at the NVOCCs, very strictly speaking, they will not get the benefit of Section 172. Income deemed to be 7.5% of the gross receipts from freight for outbound carriage of passengers, livestock, mail or goods shipped at a port in India, that is export freight, and demurrage charges, handling charges, and other charges similar to the demurrage or handling charges. And SSC is an option, as we have discussed, to be governed by Section 44B of the Act. The purpose is to make summary assessment of a ship or a voyage and ensure recovery of tax before the ship leaves Indian port. What is the procedure? The master of the ship is required to submit a voyage return to the assessing officer at the port of departure before sailing of the ship, or make satisfactory arrangement to file voyage return within 30 days of the departure of the ship, along with DIT exemption certificate if it is so obtained. In the port AO to complete voyage assessment within 9 months from the end of the financial year. So in the event when the foreign shipping company has made an application to the jurisdictional assessing officer for an exemption certificate, that is also known as an annual exemption certificate or DIT exemption certificate, that can be produced at the port. And based on that, port AO will complete the voyage assessment within 9 months from the end of the financial year. Now, issue is whether voyage-wise NOC is mandatory for foreign shipping companies which are holding DIT exemption certificate. And there's a reference to circular number 732 dated 20th December 1995, as well as circular number 30 of 2016, where it says that port clearance and voyage assessment to be done in routine manner without insisting on documents such as TRC, OM, ownership of vessel, etc., because those have been examined at the stage of the annual LOC only, and therefore the AO at the port will not go into those details unduly, wherever the name of the vessel is mentioned in the annual DIT exemption certificate. If that vessel is a new vessel, it is not included in the annual DIT exemption certificate, then obviously the port AO will go into the details of the ownership of the ship. As regards payment of commission to shipping agents, provision of Section 172 apply, and hence 194C will not apply. So this is in the case of Section 172 only. I'm afraid that in other cases, regular assessments, probably in respect of payment to commission to the shipping agents, there could be some tax withholding obligations. We'll see as we go along in our presentation. As regards Section 44B is concerned, I've given text, but we are not going for the time being into the text of that section. It overrides 28 to 43A of the Act. It means there are certain other provisions relating to business income, assessment of business income, that will not apply, but all other TDS related provisions are there, or procedural aspects of the Act are concerned. The SSCs which are governed by Section 44B will have to comply with those aspects. And applicability again is at the option of the non-resident engaged in operation of the ships. So non-resident has the option to be governed by the normal provisions also of the Act. Again, income is deemed at 7.5% of the gross receipts from export freight wherever received. And in respect of import freight, if it is received in India by virtue of a charge created under Section 5(2), that will be taxed in India, and handling charges, demurrage charges, and other charges of the similar nature also will be treated as a part of the shipping income only. And the purpose of this provision is to make a regular assessment of the non-resident under the provision of the Act. Again, the issue is the same whether voyage-wise NOC. So whatever logic that we have seen, that wherever there is an annual DIT exemption available mentioning the name of the vessel, the port AO will not go unduly into those details. In fact, if one looks at circular number 30 of 2016, it is even authorizing the custom authorities that there's no need of filing a voyage return also, no need to approach even the assessing officer at the port. And in such cases, there is a provision for issuance of a certificate by a chartered accountant, and the custom authorities can, on the basis of a certificate issued by a chartered accountant, can allow the vessel to sail. So that is, if you can look at the paragraph 7 of circular number 30 of 2016. Otherwise, though no procedure prescribed, the Memorandum to Finance Bill 1975 provides that the procedure prescribed under 172 for clearance of ship will also continue to apply to non-residents. So they will otherwise will file the voyage wise returns. And therefore, even though they are regular assessees, they will be filing those returns with the authorities at the port. So here I have given a difference between section 44B and 172 for the sake of saving the time. I will not go into those difference. We have already, whatever discussed, that is I have put in these slides. Now coming to airlines, again, it is applicable to non-resident engaged in the business of operation of aircraft. Non-resident has option to be governed by normal provision of the Act. So if they, wherever they find that 5% is too high, they can get their accounts audited. But if they opt for this 44 BBA, it will override 28 to 43A of the Act. What is covered? Export freight, wherever received in or out of India, by on behalf of the SSC on account of carriage of passenger, livestock, mail or goods from any place in India, and import freight if it is received in India on behalf of the non-resident, and purpose is of course regular assessment. So there is nothing like a summary assessment of a trip. Now, let's look at double tax avoidance agreements. The portions which have marked in blue or portions which are cancelled were part of the earlier model conventions prior to 2010 model conventions. So if you earlier also, the article ran into only 4 paragraphs, which is now reduced to just 2 paragraphs. So why 2 paragraphs? It is just 4 lines is the size of the article. So let us read this article. The paragraph 1 says profits of an enterprise of a contracting state from the operation of ships or aircraft in an international traffic shall be taxable only in the contracting state, that state in which the place of effective management of the enterprise is situated. That was the paragraph. So poem, they were finding it very difficult and it was becoming very subjective. So they deleted the portion as relating to poem, and they said it will be taxable only in the state of which that enterprise is a resident. Then profits from boats, etc., they've deleted, and it is part of again, they were talking about poem. So again, the poem portion has been deleted. If the poem was about a ship, so again, since they've done away with the poem aspect, the third paragraph is also deleted. And the last paragraph says, the provision of paragraph 1 shall also apply to profits from the participation in a pool, a joint business, or international operating agency. So when 2 people come together, they hire a ship, then it is a pooling arrangement where they assume the risk of owners or the charterers. So every person who has joined in that pool, each person to the extent of its share is assuming the risk of an operator in the shipping business. And therefore, the article will also apply to a kind of a pooling arrangement or a joint business or an international operating agency. So Article 8 is a special provision for allocation of taxing rights on profits of a non-resident. Allocation generally, almost as we have seen, it gives a taxing right to the country of residence. But one will have to look at the bilateral arrangements. In bilateral treaty, as we have seen, there are only, though new model gives only 2 paragraphs, one will have to see the bilateral treaty where the wordings may be different. So one will have to interpret the taxability based on the exact wordings under the respective model conventions. wherever you are entitled to the benefits of Article 8, existence of a permanent establishment is irrelevant. And because this is what Article 8, it has granted you special benefits. So even if there is a permanent establishment of a non-resident, it will not make any difference to them. The OECD is of course granted, as we have seen, to the country of incorporation or residence, but it is subject to bilateral variations. It applies to the profit from the operations. So we'll have to understand what is profit from the operations of the ships or aircrafts, which should be owned or chartered. Then it should be in international traffic. And what are the activities which are directly connected with the operations of ship, or what are the incidental activities from the operation of the ship, that also we will discuss. Then profit from participant pools also, though we have briefly touched, we will see. So these are, we have to understand these terms. What are the profits from operations of ships or aircraft, then the international traffic, and place of effective management. So profit from operations means profit obtained directly from the operations that it carries on by its own in the international traffic by ships or aircraft from freights for transportation of passengers, livestock, cargo, etc. And profit which could be considered to be directly connected with the operations is like incidental transfer of passenger, cargo, and ships operated by other enterprises. So it should be incidental. While you are largely owners and charterers of the ships, incidentally, in some small routes or sometimes as the business needs arise, incidentally, you will make use of other person's vessels. You may hire a slot, then you have some other income, etc., which are onboard advertisement or hotel use for transit, accommodation, etc., will form part of the profits from the operations in the international traffic. Indian haulage charges also will be covered. Similarly, lease of fully equipped and crewed ship or aircraft, which is also connected with this, will be covered. Lease of containers and short-term storage of containers, detention charges for late return of containers, etc., which are directly connected. If you are owners and charterers, and if it is directly connected, it is arguable that you will be out of. It will form part of the profits of the business under Article 8. Similarly, profits from ancillary activities, that is which make a minor contribution related to the operation of the ship, and they cannot be regarded as a major activity, like sale of tickets or advertisements of in magazines on board a ship or aircraft. Then profit from pooling arrangements, we will visit that part also. Now, certain profits like shipbuilding yard operated in a country by a shipping enterprise, etc., would not form part of the Article 8 income. Our income from deposits or bonds posted as a security required under any law in order to carry out the business would fall within the scope of Article 8. There are various countries, when we generalize the provisions, some countries have made their observations or reservations. If you look at Greece and Portugal, they have reserved their position as to the application of this article to income from ancillary activities. Germany, Greece, Mexico, and Turkey reserve their position as to the application of article to income from inland transportation of passenger or cargo. And from container services, Canada, Hungary, Mexico, and New Zealand reserve the right to tax profits from internal traffic, and Latvia reserves the right in exceptional cases to apply permanent establishment rule in relation to profits derived from the operation of ships in international traffic. So operation of ships has not been defined under the model conventions, and therefore one will have to refer to the bilateral agreements. If it is not defined under the bilateral agreements, then one will have to look at the model commentary that could provide some guidance. If one looks at the definition of the domestic law, then operation of ships is defined under Section 115 BB of the Act, that the company regarded as engaged in operations if it is operates any ship owned or chartered by it and includes arrangements such as slot charter and This is the definition, of course, is under tonnage tax provisions. And though it uses the word includes arrangements such as slot charter, that means it is an incidental slot charter. So it should not happen that you are purely engaged in slot chartering. The way it has been worded, that includes means you should have other activity, like you should be owners and charterers. Then only you can take benefit of includes arrangement such as a slot charter. But I'm aware that there are some people who are taking a view that includes means even if you are not owners or charterers, it could still include slot hiring arrangements. Now, there are some treaties where this term is not defined or it has a restricted meaning, like Singapore, Brazil, Malaysia, UAE. Let us look at that example. Now, if you look at the Article 8 of India-Malaysia Treaty, profits from the operations of a ship or a craft in internal traffic shall mean profit derived by an enterprise described in paragraph 1 from the transportation by sea or air, respectively of passengers, mail, livestock, or goods carried on by owners or lessors or charterers of the ships or aircraft. So here, income from incidental, including the sale of tickets for such transportation on behalf of other enterprise, and the rental of ships or aircraft incidental to any activity directly connected with such transportation. Then if you look at the India-Ireland Treaty, it says that profit derived by an enterprise of a contracting state from operations or rental of ships or aircraft in international traffic and rental of containers and related equipment, which is incidental to operation of ships or aircraft in international traffic. So here it is talking about profit from operations as well as rental of ships and aircraft. So if you take a ship or aircraft on rent, that means you make a lease payment for hiring a ship or aircraft from an entity which is a resident of Ireland. Then on lease payments also, there is no tax withholding, and it is governed by Article 8. As far as rental of containers and related equipment is concerned, it has to be incidental to the operation of ships or aircraft in the international traffic. Now, if not defined under DTAA, as per commentary on Article 8 and subject to observations, reservations by that thing, if you just look at one of the examples, if you look at the India-UK Treaty, Article 9, the income of an enterprise of a contracting state from the operation of ships in international traffic shall be taxable only in that state. Now, what is operation of ship is not defined under India-UK Treaty. Leasing a ship or aircraft on a full charter basis along with crew. So, wet lease, time charter, hire of vessel fully equipped and crewed, the provision of services and considered to be income from operation of ships in international traffic. That is what is provided under Article 5, paragraph 5 of OECD Model Convention 2017. However, we had an issue with Pumpuar shipping on certain facts, but it seems the recent Bombay ITAT decision in case of non-Lian Ship Management LLC, where they said it's in case of a time charter arrangement is not taxable as royalty under Section 916 of the Income Tax Act if control and dominance over the ship remained with the owner and not with the charterer. And therefore, this is a great relief, because the Pumpuar otherwise was a very, very tough decision, where even the wet lease was to be treated as a payment for wet lease was also to be treated as a payment for royalty. As regards bareboat charter is concerned, it's a hire of a vessel. It is treated as a commercial equipment, and therefore it is a payment in the nature of royalty. Under DTAA also, it does not amount to operation of ships except when it is incidental or ancillary to the main activity. So when there's an incidental hiring of an activity, at that point in time, that is to be treated as not towards payment of a royalty, and it could be incidental. And there is a decision of West Asia Maritime of a QnA 8080, which says the health charges paid for a ship taken on BBCD basis, the payment has to be in the nature of royalty. So there they say, though you say BBCD, so it was a kind of a purchase transaction. That is what was represented. But on facts, it was found out that it is not a purchase transaction, and therefore it was treated as a royalty transaction. As regards slot charter arrangements are concerned, income from leasing of one or more slots in ship belonging or chartered by a shipping company is in the nature of income from operations. That is what was held in case of joint DIT versus CMA. So this is in case of a company which has given a slot to a NVOCC. So instead of booking the cargo directly, you've given some space to other shipping company, which is NVOCC. If you get anything for that, it is also income in the nature of operations, because that NVOCC also will use that slot for carriage of passenger or livestock or goods. Income from feeder vessels, wherever you are able to establish linkages in that event with the international traffic. In that event, the income of that profit obtained from the activity directly connected with the transportation from hub ports to the destination port would be treated as a income from operations of ships, and it would be covered by provisions of the Article 8. Therefore, it is very important that you will have to establish the linkages with the main vessel, which is operating in the international traffic. As regard inland haulage charges are concerned, these are generally the charges collected from the customers towards recovery of costs incurred in inland transportation of cargo from customers' locations to ports and vice versa. Benefit of article is available to IHC, which are incidental and ancillary to the operation of ships in the international traffic, as defined bilaterally. Income from equipment for security screening, maintenance, and charter handling, the benefit of Article 8 is denied. And slot arrangements, incidental and ancillary to the operation of ships, will be covered by the benefit of Article 8, based on the benefit was granted based on the wordings in the model commentary in case of Balaji Shipping, reported in 315 ITR 62. If you look at this case study, a Sea Limited, a UK company, is engaged in transportation of goods in international traffic by ships. It earns income from two sources: freight income for international transport from vessels chartered, and income from slot chartering with feeder vessels. It declares nil income by claiming exemption under Article 9 of the India-UK Treaty, as entire income was on account of operation of ships. So question is whether Sea Limited is liable to be taxed in India on any portion of its income that is earned from India, because here there is a slot chartering arrangements with certain other feeder vessels, because they don't need full vessel, and some slot hiring is done, and they've earned the income. So in this case, we will have to look at the Article 9 of India-UK Treaty. Income of an enterprise of a contracting state from operation of ships in international traffic shall be taxable only in that state. Then if you look at journeys between the state, within one state will not be governed. And for the purpose of this article, income from operation of ships includes income derived from the rental of on a bareboat basis of ships, if such rental income is incidental to the income described in paragraph 1 of the article, notwithstanding the provision of Article 7 business profits of this convention. The provision of paragraph 1 and 2 of this article shall likewise apply to income of an enterprise of a contracting state from the use, maintenance, or rental of containers, including trailers and related equipment for the transport of containers used for the transport of goods and merchandise. And the provision of this article shall also apply to income derived from participant pool joint business of an enterprise of an international operating agency, and gains derived by the enterprise of a contracting state from alienation of ships or aircrafts. So it is talking about the capital gains when you sell off those things. So directly there nowhere it is said in the, I'm sorry, directly nowhere it says the income from slot chartering with the feeder vessels will be exempted. However, as we have seen that if it is an incidental activity, in that event, you can argue that it is not our major activity, as it was a commercially it was not viable to operate a full vessel load. Some slot arrangement has been made in that event, even in absence of the specific provision under the double tax avoidance. It is possible to argue that it is not. It is entitled to the benefits of Article 8, and that is what is held in the case of Balaji Shipping. What is international traffic? For the sake of brevity, if there is a transportation movement of cargo or passenger from one place to another place within the same country, it is not international traffic. Even in between, it may touch some other country. So this is what is described by this slide. We will not spend much time in understanding what is international traffic. Then place of effective management, again, I'll not spend much time. Suffice to say there is a CBDT circular number 8 of 2017, which is it is also defined under section 115 VC of the Income Tax Act, as well as there is a circular 8 of 2017. Poem under bilateral arrangement, wherever there is a poem, and where recently the multilateral instruments, wherever there is a poem, that has to be determined by the competent authorities. So those tie-breaking tests given or is not useful, and one will have to approach the competent authorities of both the countries to determine the poem. Profits from joint business, pooling, etc., where you pool your resources jointly and do the business. You hire a ship, two people come together and they hire a ship. That is a kind of a pooling arrangement. But there were two classic cases. One was Lufthansa, German Airlines, and there was another case of British Airways. In case of Lufthansa, German Airlines, the taxpayer was in the business of operation of aircraft in the international traffic and was a member of IATA and rendered avail certain services in India to and from other members. And IATA held that the amount received from various IATA members airlines for above services rendered in India was not taxable in India under Article 8. So some maintenance services carried out where there was a pooling arrangement, it was held that it is entitled to Article 8 benefit. But if you look at the British Airways case, the taxpayer was not a member of IATP, and there was no reciprocal arrangements with other parties, other airlines, and unilaterally rendered services to various airlines without availing any services in reciprocation. And standalone activity was not in the nature of operations of ships or aircraft in the international traffic, and therefore IATA held that the amount of services rendered could not be treated as having rendered under pooling arrangements, and hence Article 8 benefit were denied. There are various, if you look at the treaties, poem is given under Mauritius, Germany, Netherlands. So country of residence is not given in these countries. There one will have to, if there's a poem issue, one will have to go to the competent authorities will have to determine. Place of residence is given in USA, UK, Japan, France, UAE, Australia, etc. UN model alternatives is followed in alternative B in India Netherlands treaty. So some portion of tax benefit is also given to India. Pooling arrangement is there in Denmark, UK, USA, France, Singapore, etc. Clearance of ship or aircraft taxable only in the country of residence is what is provided under UK, Cyprus, USA. Interest from investments is USA, Singapore, Japan, etc. So bareboat rental basis it is incidental to main activity, UK, USA, Singapore, etc. And income from use and maintenance of containers, which is incidental, is exempted and given benefit to Article 8 under UK. And country-specific provisions, we can look at India, Singapore, Article 8 also. There, if you look at this example, so instead of going into the entire example, I will just summarize that the issue was that as far as India-Singapore Treaty is concerned, the treaty provided that income, the benefit of, if you look at Article 24 of India-Singapore Tax Treaty, which provides that where the agreement provides that income from sources in a contracting shall be exempt from tax or tax at a reduced rate in that contracting state, and under the laws in force in the other contracting state, the said income is subject to tax by reference to the amount thereof which is remitted or received in that other contracting state, and not only by reference to full amount thereof. Then the exemption or reduction of tax to be allowed under this agreement in the first mentioned contracting state shall apply only to so much of the income as is remitted or received in that other country. The issue was that while India-Singapore Treaty exempted the shipping profits from taxation in India, the Article 24 provided that the benefit of this article will be available only to the extent the amount is remitted to Singapore. In the given case, the money was, instead of being remitted to Singapore, the money was remitted to a third country. And the enterprise at the initial stage was unable to prove that this income was taxable in Singapore. If you look at the wordings, if that income was taxable only to the extent when it is remitted to Singapore, because Singapore usually follows territorial taxation. In other words, it is taxed only when it is remitted to Singapore. However, in this particular case, Singapore has issued a letter to the SSC and the tax authorities issued by Singapore revenue authorities that shipping income of Singapore entities registered as foreign shipping companies in Singapore is taxable on accrual basis. So it is not taxable on the basis of the receipt in Singapore, and therefore the restrictions as contained under Article 24 are not applicable in case of Singapore. And though there is a exemption under Singapore domestic law, that is to a foreign shipping company, but that is of no relevance. And this is what has been held in Albara Shipping Pty Limited Singapore, in PACC Container Lines, and Masrik Tankers Singapore Private Limited. There are 3 judgments, and they have followed the Far Shipping Singapore Pty Limited judgment, where it has been held the authorities that the SSC had produced the letters to the authorities that shipping income is taxable in Singapore on accrual basis. So with this, friends, we come to the taxes of NVOCC. So NVOCCs are not actually the operators of the ships or aircrafts in the international traffic, though they issue bill of lading in their own name. So we'll not go into that aspect. All of us are aware of that. So for them, it is very important that if they have a permanent establishment in India, then they are taxable in India. Read with Article 7, read with Article 7. So they will fall under business profit Article 7. And if there is a P in India, if they are dependent agent in India, they would be taxable in India to the extent of the operations carried out in India. So NVOCC has to be very much careful in this regard. Then I would also like to draw your attention to a recent decision in case of Singapore and other airlines, where though that decision is applicable to airlines, the Supreme Court has given this decision. It says that agents of airlines collect freight on behalf of the non-resident principal, and the agent is also the Section 182 of the Contract Act applies, and they remit surplus to non-resident principal after deduction of commission and other charges. Airlines have no control over the actual fare at which the agents sell tickets. So argument of the airline was that, see, there is the IATA which fixed the maximum fare beyond which airlines cannot charge to the passengers. But IATA in turn will like Make My Trip, etc. They will sell the tickets in bulk at a discount. So suppose the ticket is for 100 rupees, it is sold at 60 rupees to IATA agents. While airline will pay commission on 100 rupees at the rate of 7%. So what agents do, if instead of say 60 rupees, they sell ticket at 100 rupees. Nevertheless, they will remit say 60 rupees minus 7 rupees their commission. So they will remit 54 rupees to the airline. While they were withholding TDS on the commission portion, the amount of money was deducted. So agents themselves were paying the TDS on the commission of the their own commission as the agents. However, no TDS were deducted on the difference in the fare, which was retained by the agents. And the Supreme Court has held that the agent steps into the shoes of the principal. And secondly, whatever under an agency agreement amount that is paid, it is nothing but a kind of a commission, because it is only because of principal agent relationship that they have earned other types of income. And there was not a separate agreement to render other services or other part, or maybe for the sale of ticket, there was no other principal to principal relationship was established. In that event, the TDS is applicable on the entire portion of the amount that is retained by the agent. However, since the agents have paid the taxes, they applied the ratio in the case of Hindustan Coca-Cola beverages, and they said since the tax is already paid by the recipient agents, and therefore the tax cannot be recovered. However, interest under 201A, 1A is to be collected, and they said since this issue was not settled, time being they have said no penalties will be levied. So this aspect is very important, that when the shipping companies collect freights, etc., on behalf of the principal, when the payment is, when they remit net amount for whatever portion that is retained by the agents, is liable to be liable to tax withholding. And as the agent himself is handling, so agent would be held to be an agent of the principal, and the department can proceed to recover whatever TDS liabilities, or if the taxes are not paid, or in the event normally the agent pays the taxes, the interest could also be recovered. So that aspect has to be kept in mind. So for the sake of time, I will not travel into the provisions in IFSC. They are very easy provisions. Only I would say there is an exemption on transfer of a ship in IFSC, where 100% tax exemption is available, subject to the provision that the unit commences operation before 31st March 24. There is a 100% tax exemption in units set up in IFSC for any tax consecutive 10 consecutive years out of total 15 years. There is a depreciation on aircraft and aircraft engines shall be allowed at 40%. Unabsorbed depreciation can be carried forward without any time limit and can be set off against future profits, income by royalty or interest on lease of aircrafts. So now they included ship also. If you make lease payments for hire of ships or aircraft, it will not attract any tax withholding. So they made an attempt to I mean, compete with Ireland, because a lot of people were going. These case studies we have seen, friends, as we were going along. We have seen these case studies, and with these friends, I'm coming to an end of my presentation, and let me look at the questions which have come. What is the tax? So Mr. Kishan Das is asking the question: what is the tax liability in case of a chartering of shipping vessel by non-resident for import of goods from outside the Indian port to Indian port? Since department has taken stand that chartering of vessel is royalty, so this stance holds good not. So I've given a reference of recent Bombay ITAT decision. If it is a wet lease for carriage of, so it is a time charter where the crew and other things are provided by the lessor. In that event, the decision of the Bombay ITAT is helpful, and one will have to distinguish the fact from the Pumpuar shipping, where it was held that it was not for carriage of goods, and therefore the Supreme Court has, the High Court had refused to intervene in that judgment. One, Mr. Premal is asking the question that the tax provisions seems old, as can be seen from your PPT that dates back to 1995, 1975. Do you think it requires an overall request you to throw some light? Yeah, so these provisions are very simple and they presume taxation at a fixed rate. To be very honest, you see, India, the shipping and airlines have the huge capability to provide a good amount of export revenue to the country, and it has a tremendous potentials also to provide employment for the country. And internationally, there is no tax on movement of cargo by ships or aircrafts. In fact, 90% of our bulk cargo is moving through the shipping lines. And therefore, you rightly said that the provisions have to be liberal, because the very lot of difficulties are faced in at the port level when the vessel enters the Indian port, and therefore government and the authorities will really need to look into, so that the major shipping companies and their bulk carriers would not hesitate to enter the Indian ports. Because if the ship is detained for a day also, that will result into a huge loss to the shipping companies. So I fully agree with you that at least a procedural aspect has to be looked at it. Even the 5% or 7.5% tax is a very heavy amount, because the huge money goes into the hiring of the equipment. So I agree with Premal that the provisions needs to be looked at and should be made very friendly to the shipping and airline companies if the government is looking at other benefits in terms of the employment and the foreign exchange that it would generate for the country. Now, one Bharat Gupta has asked one question: what is the meaning of deemed to be received in India in section 44B and 44BA? If an Indian company makes the payment for import freight, would that be deemed to be received in India? Now, if the import freight, if it is paid in India, it is income received. Deemed to be income. It's a income if it is received or deemed to be received in India. So for that, one will have to. It's a very issue. One will have to then go. We'll have to travel to the charging section, section 5, 2, and section 9. Suffice to say that if that income is received in India or deemed to be received in India, so somebody has received that income on behalf of the non-resident, it could be deemed by deeming fiction that is given under section 9. If that income is received in India or deemed to be received in India, then import freight, if paid, also would be taxed in India. That is what the provisions provide. But that is under section 44B. If you are entitled to the treaty benefits under Article 8, then even the receipt in India will not matter. So if you are not entitled to the Article 8 benefit, then you'll have to be extremely careful in this regard. Now, Jimit is asking the question, where NR shipping company undertakes transportation both in international traffic and coastal, whether NR is eligible for Article 8? It's a very interesting question. See, if it is a coastal traffic is incidental and is not the real traffic, then you will get the benefit of. So if there's a movement of passengers, say for example New York to Mumbai, and in the process Mumbai to Delhi, if the passenger carried in generally it is during the course. Now it is an incidental bookage, but some issues were raised, and therefore if you are aware, earlier the international flights were carrying passengers where they were traveling from say New York to Bombay and then Bombay to Delhi. They were carrying the passengers from Bombay to Delhi also. But of late, because of the issues that they have faced with the tax authorities, they have stopped doing that. Authorities have also found that some undue advantage was being taken. But if it is a pure traffic, coastal traffic, then you will not get the benefit of Article 8, though you will get benefit of section 44B if you satisfy the condition of that section. Bharat Gupta is asking the question, what withholding tax to be deducted for making payment to non-resident airlines for freight on import of goods if the airlines has permanent establishment in India, but the payment to be made to the foreign company not be in India. Now, if the airline company is generally, if it is covered by Article 8, you need not worry. The place of payment, payment to agent, etc., is irrelevant. If airline is not entitled to the benefit of Article 8, in that event, if you make a payment, then there is an issue of taxability. And if you make payment in that event, the payer who is making a payment to the non-resident would be liable to withhold tax at the rate provided under Section 44 BBA. There's a question, what is OECD? So OECD is Organization for Economic Cooperation and Development. It is an international body largely framed by European countries, and they have drafted model treaty convention. USA has its own model, but apart from USA, there are two other models. One is the OECD model, that is for developed countries, and another is UN model. So that is a body which is for developing countries. And mostly European countries, OECD commentary is binding. As far as India is concerned, India is not a member of OECD, though India is a observer, a status as an observer. So India has been invited, and recently under the G20 as a G20 initiative, India had participated in development of multilateral instruments. So wherever the language which is identical to OECD model is used, and its term is not defined anywhere, then in courts have consistently taken help of the commentary provided in the OECD model convention for interpretation of those terms. If India has followed the language of UN, identical to UN model, the courts are following the language which is used in UN model. More or less, UN model is almost identical to the OECD model, except that UN model provides some taxing rights to the country of source also, while OECD largely gives most of the taxation rights to the country of residence and no taxation rights to the country of source. UN believes in sharing of tax revenue, and therefore that was the demand of the developing country, that we are always payer of the technology, we are the importing country, so we must get a cake. That is how UN came into existence. But one will have to look at the language and the exact provision, decide which are the commentaries which are applicable, whether 172 is applicable in case of import of goods by any vessel to India from a foreign country. Now, see, to be governed by foreign shipping company, they have the agent in India, and foreign shipping company will decide whether they want to be regularly assets as the SSC in India, or they want to do the assessment of a ship. And in that event, this particular benefit is given, and they have given a lot of exemptions from tax withholding. So at that point in time, that shipping company enjoys the tax exemption. And even agent who steps into the shoes of the shipping company also enjoys the identical exemption when he is acting on behalf of a foreign shipping company, which avails the benefit of Article 170, which avails the benefit of Section 172. Now, as far as a normal importer is concerned, in case of the question by Dinesh Chomal, importer, when he's making the payment to an agent, he will have to comply, because the importer is liable to comply with all other TDS provisions, and he will have to independently look at it. It is a case of an agent of a foreign shipping company who will be taking the benefit of Section 172. Then Mr. Jorliwala has a question. Are foreign shipping lines allowed to repatriate amounts collected from importers and exporters on account of inland haulage, EOI, fees, and multiple transactions? Yes, because whatever income that the foreign entities earn in India, subject to payment of the taxes, is a current income, and India is a as far as current income is concerned, India the income is fully repatriable. India has given the undertaking to the international agencies that the current income is fully repatriable, subject to, of course, some reasonable restrictions like gambling, etc. So whatever income that non-resident earns from India, after payment of taxes, can be fully repatriated outside India. Can you throw light on India, Hong Kong, DTAA? What should payer do if DIT is for 50%? So if it is 50% profit is to be taxed in India, then one will have to see, as far as the treaty is concerned, I'm not going treaty specific. So one will have to honor the provisions under the bilateral treaty, and accordingly, you can't get full exemption certificate, and DIT will give you only a concessional rate of 50% of the tax rate. So whatever rate is provided, it will be taxed. India will share the 50% of the tax revenue, and you will not get a full exemption under India-Hong Kong Treaty. Now, Nitin Vaidya is Atharva. Nitin is asking the question: if income from shipping business is not taxable in India due to DTAA, whether the foreign shipping company would be assessed under Section 172. As I've mentioned, 172 is only assessment of a vessel and not the assessment of a foreign shipping company, because it's not a regular assessment, not regularly, that ship is not regularly coming to India. So Port AO will determine what is the income component which could be taxed in India, and they will complete the assessment for that trip. And if the income from business is not taxable under due to DTAA, he can produce a DIT exemption. So, or he will have to produce the documents if he is not holding annual DIT exemption certificate. He will have to do the same exercise with Port AO. He will examine everything. If it's not taxable, yes, the Port AO will give you the that kind of a clearance that no tax is payable, and you will be able to. So NOC has to be obtained from the Port AO. If it's not taxable, entitled to treaty benefit, definitely you can avail of the benefits even at the port if you are not having annual DIT. Now, Mr. Avast is asking, yeah, so India, Philippines. So honestly, sir, I do not have that treaty before me, but we can one-on-one, we can take up this issue and discuss. Now, there's a question about the pilot of a passenger aircraft. The pilot is, of course, governed by a different article, and he generally, see, when depending on his residential status, so that is not, definitely does not get the benefit under Article 8. And Mr. Rathod is asking the question: if coastal is an independent activity, then NR can claim Article? No, NR cannot claim Article 8 benefit. He can look at 44B provisions, but not as far as international traffic portion is concerned. Yes, international traffic provisions are covered by Article 8, and the coastal is an independent activity. It would be taxed in India. Now, there's one question: as Section 172 deals on goods shipped at a port in India, whether Section 1 is applicable for import of goods in India? See, import of goods, if it is taxed on receipt basis, if it is taxable only if the money is received in India. In that event, Section 172 will not be helpful. One will have to look at Section 44B or Article 8 of the treaty. So, friends, I think to the best of my ability, I have answered my question. Let me look at the chat box. There is something in the chat to whether freight charges. Mr. Ajay is asking whether freight charges, custom clearing charges, and other charges paid to clearing and forwarding company is also considered shipping. No. See, clearing and forwarding agent is a person resident in India, so you can't go by Article 8. You will have to follow other normal provision of the Act. So you can't take benefit under Article 8, neither you can take benefit of Section 44B. Yeah, so PPT you can mail to us, or I request organizers if you can share the PowerPoint. then I'll be too happy to say the business assessor who is making payment for import freight to shipping company is required to obtain any declaration that is covered under section 172 or not. So he himself has to make a declaration that this is the only voyage that I have come, or he, even if he is likely to make separate trip, he wants to be assessed for that particular voyage, he can avail of the benefit of section 172. And he can declare that at the port itself, and Port AO will do the needful. I think that's all, friends. I hope whatever that I have discussed is helpful to you. If you any further questions, I'll be happy to. You can one-on-one also contact me. My contact details are given here. It will be my pleasure to be of any help to you. Thank you.